They want you to fail. They want you to treat your funded account like a lottery ticket so they can keep your registration fee. But you're not a gambler, you're a Sigma trader. Today, I'm breaking down the exact reason you pass the challenge but blow the account within a week. I've turned this strategy into a full ebook for you, but first, let's look at the chart that kills most funded traders before they ever see a payout.
The psychology of the challenge sprint. Most traders approach a prop firm challenge as a high-stakes race rather than a long-term career move. They utilize aggressive position sizing to hit the 8% or 10% profit target within the typical evaluation window, often relying on a win or blow mentality that rewarded them during the challenge phase. This creates a dangerous dopamine loop where the trader begins to believe that high risk is the only way to achieve results. When the certificate arrives and the funded account is active, the trader is mentally wired for speed, yet the funded environment requires the slow, methodical protection of capital.
The drawdown trap and revenge trading. The moment a funded trader enters their first drawdown, a shift in identity occurs where they stop trading the market and start trading their P&L. Instead of focusing on technical setups, they focus on the recovery number needed to get back to the starting balance. This leads to the revenge trading cycle, where one loss triggers an emotional response to take back what the market stole, resulting in larger lot sizes and lower quality setups. Because prop firms have strict daily loss limits, this emotional spiral usually leads to a hard breach within a single trading session, ending the trader's journey.
The professional shift to capital preservation. The Sigma trader understands that passing the challenge was the easy part. The real work is staying funded by shifting from a grow mindset to a protect mindset. Professional funded traders often reduce their risk per trade by 50% once they receive their live credentials to ensure they stay far away from the maximum drawdown limit. They treat the funded account as a business asset rather than a lottery ticket, prioritizing consistency over explosiveness. By focusing on a low-frequency, high-probability execution model, they avoid the overtrading traps that claim 90% of newly funded accounts.
The risk management formula for longevity. Longevity in the funding space is determined by the buffer strategy, where a trader treats their first 2% of profit as a shield. Until that profit buffer is built, the trader risks very small amounts, often 0.25% or 0.5% per trade, to ensure they never touch their initial starting capital. Once a buffer is established, the trader can slightly increase risk, but they never allow a single day's loss to exceed half of their daily limit. This mathematical approach removes the all-or-nothing pressure and allows the trader to survive the inevitable losing streaks that occur in every strategy.
The London and New York session combat prep. A Sigma trader does not simply open their laptop and start clicking. They treat the market open like a professional athlete entering an arena. For the London session, the focus is on identifying the initial balance and potential stop hunts that occur during the first hour of trading. The New York session requires an even higher level of caution, as high-impact news events can cause slippage that blows a funded account's daily loss limit in seconds. By mapping out key liquidity zones and points of interest before the session begins, the trader eliminates the need for on-the-fly decision-making, which is where most emotional errors occur.
The profit buffer and capital shield. The most critical phase of a funded account is the first 2% of growth, known as the capital shield or buffer. Until this buffer is created, the trader is essentially homeless in the market with no room for error. The Sigma strategy involves cutting risk in half, risking only 0.25% to 0.50% per trade until the account reaches a 2% profit mark. Once this house money is secured, the trader can revert to standard 1% risk, knowing that even a losing streak will only eat into their profits and not their initial funded capital. The news event execution trap.
High-impact news events like NFP or CPI are the graveyards of funded accounts because of slippage and widened spreads. Many traders pass challenges by gambling on news, but once funded, a single news trade can result in a hard breach if the stop loss is not respected by the broker's liquidity providers. The Sigma trader stays flat, no open positions, during these high volatility windows, choosing to trade the institutional reaccumulation that happens after the news has settled. This wait-and-see approach preserves the account while others are liquidated in the chaos.
The curse of the first payout. The period between hitting a profit target and receiving the first payout is the most dangerous time for a funded trader. Many traders experience payout greed, where they overtrade to try and make the payout life-changing rather than just consistent. This pressure often leads to a massive loss just days before the withdrawal date, resulting in a blown account and zero profit. A Sigma trader treats the payout as a bonus and not a salary, maintaining the exact same risk parameters and trade frequency regardless of how close they are to the withdrawal window. The Guardian Protocol, sustaining the funded life. The moment you receive your live credentials, your identity must shift from an aggressive challenge seeker to a conservative capital manager. Most traders fail because they maintain the same high-risk lot size they used to pass the evaluation, not realizing that a funded account is a marathon, not a sprint. The Sigma trader understands that their primary job is no longer to make money, but to not lose the account. This mental inversion, prioritizing the floor, drawdown, over the ceiling, profit, is what separates the 1% who receive monthly payouts from the 99% who blow their accounts within the first 30 days.
The scaling secret. Compounding discipline, not just capital. A Sigma trader doesn't just want one payout, they want a scaling plan that leads to seven-figure funding. Prop firms reward consistency by increasing your account size every few months if you remain profitable and disciplined. The secret to scaling is not increasing your greed, but maintaining the exact same ratio of risk as your capital grows. If you can manage 100K with 0.5% risk, you can manage 1M with 0.5% risk. The math stays the same, only your Sigma discipline grows stronger as you prove to the market and yourself that you are a professional worthy of managing millions.
The final transformation. The path to becoming a funded trader is not a journey toward more complex strategies, but a journey towards simpler, more rigid discipline. While the majority of traders are consumed by the sprint of passing a challenge, the Sigma trader understands that true wealth is built through the marathon of capital preservation. By shifting from a hunter to a guardian, you protect the very asset that provides your freedom, your funded capital. This book has provided the blueprint for that transition, but the execution lies entirely in your ability to remain locked in when the market tests your patience.
Consistency is the only metric that matters in the world of professional funding. Every trade you take is either a brick in the wall of your career or a crack in the foundation of your discipline. As you close this book and open your charts, remember that the market does not care about your goals, your bills, or your dreams. It only responds to those who respect its rules and manage their risk with mathematical precision. Stay disciplined, stay focused, and remain the Sigma trader the market cannot break.